How small apartment investors can leverage asset allocation. Define asset allocation targets. Example for a moderate investor. Real estate, 40%, which offers stable cash flow and appreciation potential. Equities, 30% for growth-oriented returns. Fixed income, 20% to provide income stability and reduce risk. And alternative investments, 10% for diversification and unique opportunities. Construct a portfolio. For real estate, include a mix of multifamily properties, REITs, and commercial assets to diversify income sources and geographic exposure. When it comes to equities, select real estate-related stocks or ETFs alongside growth stocks for capital appreciation. For fixed income, add municipal bonds or mortgage-backed securities to generate steady income. And for alternatives, consider private equity or real estate crowdfunding opportunities for higher returns. Alright, so let's talk about evaluating risk and returns. You'll want to calculate your portfolio risk using metrics like standard deviation and the Sharpe ratio. Then, it's important to assess your projected returns in relation to your investment objectives and, compare them against historical benchmarks. So, it's important to adjust over time. Regularly review your asset allocation to make sure it still lines up with your changing goals and any shifts in market conditions. And don't forget to rebalance periodically, just to maintain your target allocations and avoid getting overexposed to any specific asset classes. Let's look at an example of optimizing risk-return trade-offs through asset allocation. Imagine an investor with, say, $1 million to allocate and a moderate risk tolerance. They put 40% or $400,000 into multifamily properties that generate a 7% return. 30% or $300,000 goes into growth stocks with a 10% return. 20% or $200,000 is invested in bonds, which bring in a 4% return. And finally, 10% or $100,000 is allocated to private real estate syndications, generating a 12% return. When you add it all up, the weighted return comes out to 7.6%. Volatility is actually reduced by balancing those high-risk equities with more stable fixed income and real estate assets. There are some clear benefits for small apartment investors. For steady income, real estate and fixed income can provide consistent cash flow, which really helps support financial stability. When it comes to growth potential, equities and alternatives give your portfolio a boost for long-term capital appreciation. Diversification is key too. Combining different asset classes helps your portfolio stay resilient during market downturns. And of course, there's flexibility, since asset allocation can be adjusted to fit new opportunities or changes in your risk tolerance. In summary, strategic asset allocation is a critical part of effective portfolio management. It helps small apartment investors balance risk and return while working toward their financial goals. By defining clear allocation targets, building diversified portfolios, and regularly evaluating performance, investors can create portfolios that are resilient, adapt to changing market conditions, and support long-term success.